What if I told you there's an industry where a single decision can turn millions into billions, where struggling companies are transformed into global powerhouses, and where fortunes are made not by luck, but by strategy? Welcome to the world of private equity, a high-stakes game of vision, expertise, and calculated risk. It's a world that has created some of the wealthiest individuals on the planet and reshaped entire industries. But how does it actually work? And more importantly, what can you learn from it? Here's a jaw-dropping fact to kick things off. Private equity firms collectively manage over $4.5 trillion globally. That's more than the GDP of most countries. Yet behind these staggering numbers lies a surprisingly simple concept: identifying potential, making strategic improvements, and creating value. Think of it as flipping houses, but instead of properties, they're flipping businesses. But here's the twist: private equity isn't just about money. It's about seeing opportunities where others see obstacles, and turning those opportunities into extraordinary results. So buckle up, because today we're pulling back the curtain on this fascinating industry. By the end of this video, you'll not only understand how private equity works, but also how its principles can help you create value in your own life. If you're ready to dive in, don't forget to hit that subscribe button and give this video a thumbs up. Let's get started. Private equity starts with one critical step: fundraising. Imagine this as building a war chest for future battles. Private equity firms raise capital from institutional investors like pension funds, university endowments, and ultra-wealthy individuals. These investors, known as limited partners, entrust their money to the private equity firm or general partner for a period of 7 to 10 years. It's a long-term commitment built on trust and the promise of expertise. But here's where private equity gets its edge: leverage. Firms don't just rely on the money they've raised. Instead, they combine it with borrowed funds to acquire companies worth far more than their initial investment. This strategy, called a leveraged buyout, is the secret sauce that amplifies returns. Think of it like buying a house with a mortgage. You put down a fraction of the cost, but you control the entire asset. Let's break it down with an example. Imagine a private equity firm identifies a company worth $100 million. Instead of paying the full amount, they might invest $40 million of their own capital and borrow the remaining $60 million. By using leverage, they control a $100 million asset with just $40 million up front. If the company's value doubles to $200 million, their $40 million investment could yield a massive return, but only if they execute their strategy flawlessly. Once a private equity firm acquires a company, the real work begins. This is where they earn their reputation as value creators. Unlike passive investors, private equity firms actively work to improve the businesses they acquire. They use three main strategies to unlock value. 1. Operational improvements. Private equity firms often bring in experienced management teams to streamline operations, cut unnecessary costs, and optimize efficiency. Think of it as decluttering a messy room. Every decision is aimed at making the company leaner and more profitable. For example, they might consolidate facilities, upgrade outdated technology, or restructure the organization to eliminate redundancies. These changes may seem small, but they can have a massive impact on the bottom line. 2. Strategic repositioning. Sometimes the key to unlocking a company's potential lies in rethinking its direction. Private equity firms might help a business enter new markets, develop innovative products, or make strategic acquisitions. They leverage their extensive networks and industry expertise to open doors that were previously closed. For instance, a regional company might expand internationally under the guidance of a private equity firm, tapping into entirely new revenue streams. Number 3. Financial engineering. This is where private equity firms fine-tune the company's financial structure. They manage debt efficiently, implement tax-advantaged strategies, and ensure the company's capital is working as hard as possible. It's like tuning a car engine to extract maximum performance. Every adjustment is designed to enhance returns. Here's a real-world example. In 2007, Blackstone acquired Hilton Hotels for $26 billion. At the time, Hilton was a well-known brand, but it wasn't reaching its full potential. Blackstone saw an opportunity. They expanded Hilton's international presence, improved operational efficiency, and transformed its business model. 7 years later, they sold their stake for a profit of $14 billion. one of the most successful private equity deals in history. While private equity can deliver extraordinary returns, it's not without risks. Success requires deep market knowledge, operational expertise, and meticulous risk management. The best firms excel at due diligence, a rigorous process of investigating potential investments before committing capital. They analyze everything from financial statements to market conditions, competitive dynamics, and potential risks. It's like inspecting a house before buying it. You need to know exactly what you're getting into. But here's the twist. Not every deal is a success. Some companies fail to turn around, and the leverage that amplifies returns can also magnify losses. That's why private equity firms must be both bold and disciplined, balancing ambition with caution. Let's address a common misconception. Some critics view private equity as purely destructive, focused only on cost-cutting and job elimination. While restructuring can involve tough decisions, the ultimate goal is to create stronger, more sustainable businesses. In fact, research shows that private equity-backed companies often experience faster long-term growth and create more jobs than their peers. It's not about tearing businesses down, it's about building them up. Private equity investments aren't forever. The typical investment horizon is 3 to 7 years, during which firms implement their value creation strategies and prepare for exit. This is the moment when they realize their returns and move on to the next opportunity. There are 3 common exit routes. 1. Strategic sale, selling the company to another business that sees value in acquiring it. 2. Secondary buyout, selling the company to another private equity firm. 3. Initial public offering, IPO, taking the company public, allowing it to raise capital from the stock market. Each exit strategy has its own advantages, but the goal is always the same, to maximize returns for investors. Even if you're not a billionaire investor, the principles of private equity can offer valuable lessons for anyone. Here are 3 key takeaways. 1. See potential where others see problems. Private equity is all about identifying opportunities that others overlook. Whether you're an entrepreneur, a business leader, or an individual investor, train yourself to see potential in unexpected places. 2. Combine expertise with action. Private equity firms succeed because they combine financial, operational, and strategic expertise with decisive action. In your own life, don't just execute. Think long-term. Private equity is a patient game. It's about making strategic decisions today that will pay off years down the road. Whether you're investing in your career, your business, or your personal growth, adopt a long-term mindset. The private equity industry is evolving. Today, environmental, social, and governance, ESG considerations are becoming increasingly important. Firms are focusing not just on financial returns, but also on sustainable value creation. They're investing in renewable energy, healthcare innovation, and technology that addresses global challenges. This shift reflects a broader trend, the recognition that long-term success requires balancing profit with purpose. For those inspired to participate in private equity, there are multiple paths. You can invest indirectly through publicly traded private equity firms or mutual funds, or you can work in the industry itself. The key is understanding the fundamentals we've discussed today. Private equity is often seen as a world reserved for the elite, but at its core, it's about something universal. Seeing potential where others see problems and having the courage, strategy, and expertise to act on it. Whether you're an investor, entrepreneur, or simply someone looking to create value in your own life, the principles of private equity can guide you towards success. Remember, the magic of private equity isn't magic at all. It's methodical. It's about combining financial acumen, operational expertise, and long-term thinking to transform potential into extraordinary results. The same mindset that builds billion-dollar deals can help you build your own success story, no matter the scale. So the next time you face a challenge, ask yourself, what opportunities are hidden here? What value can I create? Because the truth is, every great transformation starts with someone seeing possibility where others don't. If you found this video valuable, don't forget to hit that subscribe button, give it a thumbs up, and share it with someone who needs to hear this. And we'd love to hear your thoughts in the comments below. What opportunities are you seeing that others might be missing? Let's start a conversation. Thank you for watching. And remember, the principles of private equity aren't just for billionaires. They're for anyone ready to think bigger, act smarter, and create lasting value. See you in the next video.